In today's episode, we're going to talk about ETFs. What's an ETF? 5 ETFs that I use in my portfolio, how to evaluate ETFs, why you might want to choose ETFs over individual stock picks, how ETFs and dividends can work together. All that and more on today's episode. So we'll get started here in a bit. But first, if you want a channel that's going to help you speed up your journey to financial freedom through dividend growth investing, Stately Investing is the place for you. So hit that subscribe button below. All right, everybody. So let's talk about ETFs. So first, some of you guys might not know what an ETF is. It's an exchange traded fund. And what that means is, as this article here, I'll link this down below. But an ETF is a basket of securities, meaning it's a bunch of stocks put together, typically, which are sold on an exchange. So you buy into that one fund, and they have several holdings within that fund. ETFs are traded throughout the day. It all is, kind of based on supply and demand, like stocks, and like mutual funds. ETF shares represent partial ownership of the portfolio that's actually within that holding or within that fund. So there are several different types of ETFs. This article goes over them nicely. So diversified passive equity ETFs, you can think of these as kind of index funds. So they're trying to mimic an index that already exists out there, like the S&P 500 or other indices that perform, and these typically track pretty closely to however those indices work. Then there's some niche passive equity ETFs. So these typically mirror a subset or a sector within a group of funds. So rather than the whole index, it will take on a specific industry or a specific set of criteria within the greater, bigger index. Then there are active equity ETFs. So these are actually letting the managers of those ETFs pick and choose stocks, but they're doing it on your behalf so that you don't have to. And those active ETFs will sometimes outperform the market, right? So rather than just investing in an index, it will actually outperform, but it can also underperform. And then fixed income ETFs, this last category here, focus on bonds rather than the stocks. And so they're usually actively managed as well, but they have low turnover, and we'll talk about what turnover is in a bit. So you guys know me as a dividend growth investor, and you know that I like to pick and choose individual stocks in my passive income portfolio. And you know that's typically not an ETF-based activity, right? So why are we talking ETFs today? Well, I was looking at one of my rollover IRA accounts, and I have several accounts that I just don't actively manage the way that I manage my passive income streams. And so I looked at that and I said, well, I want to rebalance this IRA. I want to pick out some better funds that I think would be better and align with some of my other passive income activities, and better pick and choose those funds so that I'm getting a better return on my investment. So when I was evaluating that rollover IRA portfolio, I decided I'm going to reallocate my funds into 5 ETFs. And I picked and chose these ETFs based off of some key metrics. And so I wanted to walk through that with you guys today so you can learn about how to evaluate an ETF. So we are going to reveal them one by one, and you guys can see the metrics that I'm using. So we're going to look at the 5 funds I chose and the metrics I used to evaluate them. So let's reveal the first fund. So the first fund is, drum roll please, MTUM, which stands for, it's the Momentum Factor ETF, MTUM. And these are the metrics that I use. So we'll talk about what momentum is in a second, but first let's talk about the metrics. So yield, you guys should be familiar with yield if you follow my channel. Yield is basically the return that you're getting through dividends over the share price on an annual basis, on a 12-month basis. The next metric I look at is dividend growth. So their dividend growth rate over 5 years. And actually, for these funds, again, remember ETFs for me are more kind of, I don't actively manage those portfolios. I'm just kind of picking and choosing and letting them run. So 5 years is actually a short time window for me, right? I'd rather be looking at something like a 10-year, 15, 20-year evaluation. But for purposes of comparison, some of these ETFs are not as old. And so I wanted to make sure I had data across all of them to evaluate them. So this dividend growth over 5 years is basically just, how much they're growing their dividends over time. And in this specific case, 5 years. The next one is the 5-year annual return. So this is, if you looked over the last 5 years, this is the average rate of return across those 5 years. And so for momentum here, MTUM, it's around 14.76%. The next one is expense ratio. So expense ratio is how much does it cost you for those funds, right? So this is 0.15%, right? So not 15%, but 0.15%. So it's relatively small. Overall, you'll see that some of these funds have really low expense ratios. Basically, for every $10,000 invested, I'm going to pay them $15, which is pretty low. But overall, there are some other lower ones here on the list, and that's something you definitely want to look out for because you don't want to lose money due to fees and management. And usually this has to do with how actively they're managing the funds, right? Whether they're making trades and kind of taking a trading approach versus an investing approach. I'll put a link in the cards to that video as well on trading versus investing. And this gets to the last metric here, which is turnover. So momentum here has a high turnover at 138%. That's actually relatively large. It is something where you can see if they are trading actively or passively and just how quickly they're turning over the shares in their portfolio. So let's get a deeper look at turnover and what it means. All right, so turnover basics, right? So the idea of an ETF is that they can trade and sell and buy stocks just like you and I, and turnover is a measurement of how frequently they're turning over their positions. So you can see here from this article, and I'll put a link in the comments below, is a turnover ratio of 100% means the ETF or mutual fund has bought and sold all of its positions within the last year. A relatively low turnover ratio, which is about 20 or 30%, means they're buying and holding their assets, right? Their stocks. So typically a high turnover ratio, either 100 or more, would indicate where they're trading, right? They're doing a lot of activity. And so they're kind of repurposing and rebuying and selling stocks in order to achieve a certain strategy. So if we jump back to momentum here, you guys can see that its turnover ratio is pretty high. So let's jump into what momentum means as well, and that will help us understand what this fund is trying to do. So momentum indicates stock price strength, as this article here says, and again, I'll put a link down below. Momentum is the speed or velocity of price changes in a stock. So it looks at how frequently or how fast prices are changing for that particular stock. And what momentum, that ETF that I'm looking at particularly does, looks at potentially looking at companies that increase with price changes, right? So it looks at kind of the speed of the curve of the price of that stock, and companies that are trending upwards, they will buy, and then companies that are trending downwards, they will sell, right? And so it's all about price curves. So it's a very different way of investing than what we typically cover here in the channel. But momentum is typically a good indicator of, of stock price changes, obviously. And so it also is an indicator of value and whether or not you should be buying or selling. And so this fund has done fairly well over time. So let's jump back to the fund, and you can see its annual return is pretty high. We'll get into some other choices here. Hopefully that gives you guys an explanation on what momentum is, and let's reveal the next fund. So the next fund is NOBL, which is NOBL. This is the Dividend Aristocrats ETF. So NOBL looks at replicating essentially the Dividend Aristocrats, and the Dividend Aristocrats are basically any stock in the S&P 500 that has increased its dividend for 25 years or more. And I believe that is in the US. So these are S&P 500 companies, and it's only 25. You have to have had growth for 25 years or more. So if you look at the metrics again, right, so their yield is 2.67%, pretty typical for dividend growth companies, especially dividends that have grown for a very long period of time. Dividend growth rate is at 12.34%. This growth rate might look lower than momentum, but that would make sense because momentum is probably starting with very low yields and and it's slightly going up every year, or increasing every year. So their growth is actually going to be higher. But these are already companies in NOBL that have a very good dividend position, so their growth is a little slower. You can see that the annual return is 9%, and the expense ratio is 0.35. So relatively expensive, but again, you're buying into the best companies here. And the turnover is relatively low at 20%, meaning they are not changing the stocks here. This would make sense, right? Because the criteria is so restrictive. You have to have been growing your dividends for 25 years or more, and that is a hard rule for this ETF. So they're really not going to change, basically, unless the company is newly reached that criteria, or a company has cut their dividend and aren't growing it anymore and they fall out. So those are the rules for NOBL, and obviously it aligns with my approach for dividend growth investing. The next the next ETF to reveal is VIG. So this is a Vanguard fund. So this is the Vanguard Dividend Appreciation stock, right? And this is another dividend growth oriented ETF. Its yield is 1.94%. And its growth is at 6.13, so a little less than NOBL. However, its annual return is 10.73. So the criteria for this is a little less restrictive, right? VIG can have assets, not necessarily only in the dividend aristocrats. They're picking companies that also are dividend growers, or that they suspect will be dividend growers in the future. And you can see that this expense ratio is really low. So this expense ratio difference between NOBL and VIG also can show you why the growth rates might be different. However, the annual return is also slightly better with VIG. And this expense ratio may not matter when you're investing small amounts. Even like we said, $10,000 is a small amount, so $35 versus $6, not a huge deal. But when you're talking millions, this is actually a fairly high number. And then their turnover is even lower than NOBL, and that is 14%. So why don't we reveal the next company? And that is VUG, another Vanguard index. So this one is the Vanguard Growth Index. So this one is not focused on dividend growth in particular. It's focused on growth companies, somewhat similar to Momentum, because Momentum typically will look at growth companies as well. But VUG is yielding 0.92%, so very similar to Momentum. However, its dividend growth is lower. Again, not focused on dividends, 6.64%, which is not bad at all. And then its annual return, again, very close to Momentum's at 15%. However, the expense ratio is much lower at 0.04. And the turnover is much lower than Momentum, right? So whereas Momentum takes a very active trading approach, VUG takes a buy and hold approach. And so they're just picking companies and holding on to them. And they are typically growth, large capital companies. Lastly, let's look at the last reveal here. And we will see the last fund is VYM. So this is the Vanguard High Dividend Yield Index. And even though it says high dividend yield, you can see the yield right now is 3.77%, which is, higher than all of the rest of these funds that I have. But overall, not anything absurd. I think this is completely manageable. You can see that the dividend growth is at 8.29%, so lower than NOBL, but higher than some of these others, and that would make sense because these are high yielding stocks, so there's a little less ceiling room for it to grow. And then the annual return is 6.68%, which is actually the lowest of all of these. That tends to make sense as well, because the high yielding stocks, you're typically looking for your dividend yield to be high, but not necessarily the performance of the stock to be high. And then a very low expense ratio, again, of 0.06%, similar to VIG. And this has the lowest turnover of all, right? So it's looking at pretty high yield stocks, and it's just holding on to those stocks in their fund. So hopefully you guys got something out of all of these metrics. Leave a comment below if you think there are other metrics I should be using to evaluate ETFs, or anything that you guys use when you're looking at ETFs that would make sense for future videos. So why would you pick an ETF over individually choosing your stocks? So you guys can go to ETF.com. This is a site where you can actually compare ETFs. You can see the 5 that I actually put in, right? And you can see generally it gives you some fund basics, the name and their expense ratios. and then also just kind of their annual amounts, so how large the fund is. But why would you ever pick an ETF over individual stocks when you think, oh, stately investing, I can do better. I can pick out the exact stocks that I want. Well, for some of you advanced investors out there, that might be true, right? So if you look at most of my videos, we're talking about individual stocks. We're looking at my passive income portfolio. But for a lot of people who are just getting started, ETFs are a great way to approach investing in the stock market, whether you're doing dividend investing, growth investing, or other types of investing. ETFs can be a good way because, and what you want to look for there, this is where size comes into play. So the larger the fund, the better, because you know that they have huge amounts of money. They are going to typically not blow through those people's money. As people invest, they need to manage those stocks and manage those funds correctly. And so, I typically tell people to invest in Vanguard ETFs. They have a large variety of ETFs. They have very low expense ratios, and they're very large in size. And so, and you can typically find whatever strategy you're looking for in one of the Vanguard funds. I tend to look at dividends, as you guys well know, and then also large capital growth when I'm looking for growth-oriented funds. But you can find a variety of things. You can find bond funds. You can find the wide spectrum with Vanguard. So I would recommend ETFs for folks who are new to investing or folks who just don't want to have to actively manage individual stocks, right? It does take time to individually manage those things. ETFs are a good way of just kind of setting it and forgetting it. And if you're picking good ETFs, you can literally ignore them for years on end. You wouldn't have to touch them. You can hopefully see good returns and know that your money is well taken care of without having to constantly monitor what's going on. So those are the reasons why a lot of people like ETFs. I think, each individual is different, right? So do your research and make sure that you are understanding the difference between an ETF, a mutual fund, and individual stocks, and knowing what is the right choice for you. And lastly, today we're going to talk about how ETFs and dividends can exist together, right? So I think these are the types of funds that I invest in for dividends. So VIG and VYM and NOBL, those are the three that really are dividend oriented. If we look at VYM, you can see that it's rated A here, a really high score. And then you can get some additional details of what it's doing, right? So you can see kind of the benchmark here, the benchmark values and how VYM is performing relative to that benchmark. You can see that it's a relatively old fund, right? So 2006, it's actually, it survived the 2007, 2008 financial crisis. It has a lot of assets under its management. And then here are some of the competing ETFs, so you guys can actually research those. But overall, this is a dividend-oriented fund, and it will tell you what sectors it's in, right? So maybe you have a bunch of individual stocks in healthcare, and so you wouldn't necessarily want to add to that by VYM, although VYM is pretty spread out across a lot of industries, which I like. It also will tell you the top 10 holdings. So these are companies that, guess what, surprise, I own a lot of these companies in my passive income portfolio, right? So Johnson & Johnson, AT&T, P&G, Cisco, right? It goes through kind of all of the top 10s, and it shows you how much of the top 10 is the entire portfolio. So they're picking quality stocks that are high yield in this case, and I think you don't have to abandon your dividend strategy by investing in an ETF. Those two things aren't mutually exclusive. They can go together, they can work together, and you can use them to perhaps not have to actively manage all of your dividend investing decisions while still maintaining a certain dividend strategy. So I think they can work together really well. Don't listen to people who say if you're doing dividend growth investing, you have to pick out individual stocks. That's not the truth. Like I said, go out there and do your own research. So hopefully you guys got a lot of information out of this video. Super helpful for me just to go through and reevaluate my portfolio and hopefully show you guys something or teach you guys something you didn't know about ETFs previously. Feel free to leave comments below. I'm always trying to learn from you guys. I appreciate all of the comments. If you got something out of this and you want to show your support, feel free to hit that subscribe button, and I will see you guys again next week.